Hi, I'm Peter Rose, founder of Longwood Currency Trading. It's a mystery as to how to trade candles to some people, and I think that's because you're looking at the wrong thing. Look, a candle is an arbitrary slice of time that you're looking at price action, right? You have order flow that's going on. Now, does the guy who's placing the order say, oh, in the next 5 minutes I've got to place this order, or in the next hour I've got to place this order? No. The candles are broken up into time frames for our benefit to look and see what's happening. So what is the purpose of the closing point of a candle? Because you go to the next candle and it's going to open at the close of the last candle. What does that tell you? Where's the separation line between the information held supposedly in those two candles? If you're on a 5-minute chart, you got a 5-minute candle that goes here, and then you get the next one. Well, the next price would start here, right, and then go up if we're talking about rising price. So what if instead of looking at two 5-minute candles, I looked at a 15-minute candle? How would I determine what to do at that 5-minute point? There are going to be 3 5-minute candles in that 15-minute candle. So what information really is it that the 3 5-minute candles have that the 15-minute candle doesn't have? It's the continuation, it's the momentum. Because if you wait 15 minutes, you may get let's say you get a pin bar that's, well, let's say the ATR of the 5-minute candle is 5, and the overall ATR of the 15-minute candle is 7. There's not much difference between the two because the 5-minute candles will go chick, 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 chick like this, and in the long run you're going to get a 7-pip overall move on the 15-minute. That's important information to have. But you're absorbing that 15 minutes of history. That 15 minutes of history is absorbing the 5-minute intervals as to how it got there. And those 3 5-minute intervals are 15 1-minute bars, right? And so when we talk about price action being fractal, we mean that the action of a series of 15-minute bars is going to be the same and undifferentiatable from 15 5-minute bars or whatever configuration you want to display. If you displayed 2 charts, one with 1-hour candles or 1-day candles and the other chart with 5-minute candles, and you took off the axes, you wouldn't be able to tell the difference between them. They'd look the same unless you had an axis to say, oh, this candle moved 80 pips and this one moved 5 pips. You wouldn't be able to tell whether you were on a daily chart or whether you were on a 5-minute time frame. So what can you learn? If your trade is going to last for a month, there are 20 trading days, right? And so the daily candle is going to show you what happened over a 24-hour period of time. Now, the problem I have with that is the data in that candle contains information when nobody's there. You're in a dead zone. If you look at you can see it really well on a 15-minute time frame. As you go to the close, when the 2 pair countries are maybe at their least active, you get what we call a damped harmonic oscillator wave. Normal trading, might take you like this, candles going. But as you go toward the end of it, you know, you might get these, and then they get smaller, and it kind of comes down. So you have two converging, well, parabolic type curves that come to meet until the open happens, and then you start to get more volatility and you get normal trading. So that 1 day candle is absorbing a huge amount of time, but doesn't do anything. The weekly candle absorbs a lot of information. But what it does tell you is that in the long term, over a week's period of time, price is going up. Well, that's great. But a daily candle, I don't know what the weekly ATR is because I don't really pay much attention to the weekly, but the daily ATR on most of the major pairs is, let's say it's 80 pips or 100 pips. Could be 50, could be 180. It depends on the volatility. But if you look at a long-term ATR, and not the 14 period, but whatever longer time frame you have, it's like smoothing out the price action with a 200 moving average as opposed to a 21 period moving average or an 8 period moving average. So you're looking at what information is contained in a 5-minute candle. As a day trader, I'm interested in the 15-minute and the 5-minute candles, because the guy that's placing that trade is going to put that trade on, and he's going to want to see if it worked so that he can put another trade on to either get out of that position, selling, or buying and building his position. So he's not going to put a position on at 9 o'clock this morning and then wait until 9 o'clock tomorrow morning. Even if it's a $2 or $3 billion order. I mean, look, he's got to get rid of this shit. He can't be holding it on his desk. The client wants to transact business with another country, and they need to get the currency translated into that from one pair into the other pair. So the guy can't sit there picking his nose. He's got to get this stuff done. So he's going to be at that desk and most active when the New York Open happens at 7:30, 8 o'clock in the morning. That's when the New York USD pairs are going to be most active. Sun hits New York before it hits Los Angeles, and so you're going to have that activity happening before then, whereas maybe in Los Angeles you're doing an Asian session when maybe you're catching the beginning of the European session, London session, New York time when that opens. Regardless of that, Eastern U.S. time, 7:30 a.m. Is when the U.S. starts, but in U.S. time it was 2:30 or 3 in the morning when the London session opened. So 5 hours later, we're into 5 hours into the Euro session when the U.S. opens. So they've got another 3 hours to go, but they're waiting to transact their business with the U.S. And Euro-U.S. is the most active combinations of pairs that you can get. You're certainly going to get some trading in the Aussie, the yen pair, of course, but there's not going to be as much economic activity as there is going to be between the euro and the dollar, or the Swiss franc and the dollar. You know, the dollar, because it's a big pair. The euro is a big pair. Between those two, I mean, euro dollar is the largest pair. I think it's something like, I don't know, I'd hate to throw out a number, but I'm not real sure, but it could be as much as 30 or 40% of the currency pair activity on a daily basis. It's huge. Because there's so much, the U.S. is transacting so much business and the Eurozone is attracting so much business. Australia is a large power, but it is dwarfed by the Eurozone and by the U.S. And so the candles are going to behave differently when you're trading more active pairs than inactive pairs. that doesn't mean that you can't make money in the transaction, because regardless of what is going on, the traders are transacting a lot of money, and they're going to move those candles. Look at the Aussie USD pair, or maybe the Aussie New Zealand pair, and look at the difference in the ATRs and of the maybe of the daily chart. You're probably not going to get a Aussie New Zealand ATR to be what the Euro USD ATR is going to be on a daily basis. So the candle that you're working with can't be discussed in generic terms, I guess is what I'm talking about. Which means that if you're looking at getting more pips from your trading, you're going to have a hell of a lot more difficulty trading Aussie New Zealand than you would trading USD, the pound dollar, for example, or a euro dollar, or something like that. And that's why my premise has always been, don't trade for the pips. You have to have a methodology that says over all the pairs, because you want to be able to trade all the pairs. Over all the pairs, in transacting business, how much dollar value, put it into whatever terms your currency is going to need to happen. If I'm in Thailand, my currency transactions on the bulk are not going to move the market as much, but in the trading one of those pairs that's not as active, it's still a lot of money for them. They want to buy 500 US cars. That's a lot of money. And so that pair interaction with the US, or maybe they're going to buy cars from New Zealand or something, those are large dollar baht Aussie currency values that are percentage-wise the same importance that you would have in USD. And so what I'm saying is that not only is the price action, whether you're doing a daily chart or you're doing a 5-minute chart, fractal. In other words, the price action on a 5-minute chart without axes is going to be the same, look the same as the price action on a daily chart. That's a fractal price action. Your candle sizes are also going to be fractal in their nature, but you're still going to have to cover the number of pips necessary to translate from one currency dollar pair into another to buy a car. I mean, there's going to be that thing. So you have to, when you're looking at trading candles, you're looking at candles representing order flow, right? And so what are the orders consisting of? If you're transacting for 100 planes, then the candles are representing a far greater dollar volume, and therefore you may get more pip action from that pair than you would if you were transacting 20 carloads of grain coming out of Thailand going to Korea or Greece or something. You have to balance the information that you are interpreting from a candle in a specific pair based on all of those economic scenarios, because if you don't, you're going to fall into the habit of thinking that you can get more pips from your trade than you're really going to be able to. So these guys that are talking, educators, are saying, oh, you know, you get 10 pips a day, you get 20 pips a day, we're making 40 pips a day. Are they really making 40 pips a day, or are they making 10 pips a day on 4 lots? You're still getting the equivalent of 40 pips, but you only did it on 10 pips. So you really have to back down in your candle analysis to reasonable distances that these candles are your expectation of what those candles are going to move, the distance they're going to move before they retrace or taper out in their fractal nature. So it's so critical when you're looking at your charts and you're looking at these candles and you're saying, oh, I've got an engulfing candle pattern here on the 5-minute chart. Doesn't mean anything nearly what that same pattern may indicate on a daily chart. The problem is, if you're waiting for the engulfing candle pattern to manifest itself on a daily chart, you're more often than not going to get hit unless you're a good trader and you're trading for that long term with a loss, and because of the leverage that we're dealing with, could be a severe loss. So you look at your FOREX trading charts and you're saying, what's the scalability of a country's ability to transact business? And then you look out at the monthly charts and you go back 4 or 5 years or 10 years and you say, what are the extreme boundary conditions that this currency pair or currency has traded at? Because that's all they're able to do, and that's all they're able to lose. And so somewhere in the middle there, after looking at, I don't know, 4 or 5 or 6 years of data, what difference does that make to me as a currency trader trading on the 5-minute chart? Well, it could mean a lot, because those 5-minute candles could be telling you something as they're approaching the extreme boundary conditions of that pair. And those extreme boundary conditions might not be 5 or 10 years. They may be, I don't know, 2 or 3 months before. A 2 or 3 month before candle explosion or something may affect some economic event that's occurred. Well, look at what went on at the start of the pandemic. Look at the volatility that happened. And look at the volatility that happened at the end of 2022. I made, because of that volatility, made a tremendous amount of money. And then it flipped around and I lost a tremendous amount of money, but I cut it so that I was left with a good size amount of money. So I did well, but nowhere near as well as the volatility. But that's okay, because you're playing probabilities. You have to really change the way that you think when you're in volatile conditions as to the considerations and emphasis that you're applying toward any candle, single candle, or any candle pattern, so-called patterns. I don't believe in those, or setups. I don't believe in those, because it's not based on anything. It's based on, well, what's happening in this 5-minute candle and the next 5-minute candle. But those are buried in the 15-minute candle. And 2 or 3 15-minute candles are buried in the 1-hour candle. And the 1-hour candle, 2 or 3 of those are buried in the daily or the 4-hour. And it just goes on. You have to be able to step back from things and say, well, this is all fractal. If I'm trading on a daily chart, I should be looking for a 200 or 300 pip run. But I'm not going to get it in 2 or 3 days. It may take me, a couple of months of this. Because if you look at the daily candle with an 80 pip ATR, it's not going up, 80 pips and 80 pips and 80 pips and 80 pips. It goes up 80 pips, and then the next day it'll come down 60 and go up so that it goes above the close of the previous candle, maybe by 10 pips. It's a creeper. Okay, and so the volatility increases the creepiness of it. Not strange, but the crawling part of it. So when you're looking at these people are talking about these candle patterns and these setups and God, the guys that are using the Fibonacci and all the rest of this stuff, it makes no sense at all. You have to look in terms of relativity. Einstein talked about that. I studied that in my physics background. Everything is relative. What's it relative to? Well, I use that in my trading, and the folks that work with me on an extended basis, certainly not somebody answering a comment in a video or taking a course or something like that, but people who constantly would work with me, we can talk about how you look at things relatively in the currency market. And it's particularly true in the currency market, not so much in the stock market or the commodity markets, which close and have gaps and are dependent on crazy people doing crazy stuff. I mean, in commodities, you can go absolutely nuts. Just the hint of a drought somewhere is going to drive wheat prices wacky, right? Or this stupid Robinhood thing with GameStop stock. It just doesn't make any sense at all. Or several years ago, Bank of America stock at $3.50, and Warren Buffett goes, well, that doesn't make any sense, and buys it. Well, how did it get to $3.50? It just, all that stuff is so crazy. And in the currency markets, we don't have any of that. We have our own problem, but we're not encumbered by that. We can use these candles, and we can look at progressions of candle movements in a relativistic way in comparison. What are they doing right now, and what did they do 5 days ago? And those comparisons are important, because the guy that gets on the desk with a $2 or $3 or $4 billion order, he's not going to dump it all on the table in a couple of days. It's going to take him maybe weeks to get that out. So there's a progression of movement that's going on with that particular order. Well, if he's getting rid of one currency pair and buying another, then the guy on the other side of the coin has got to be buying what he's selling. And so they're doing the opposite side of that. Will those activities cancel each other out? Or will they, like two sine waves that are going along like this, and they get together and they make a big wave, like an ocean wave? Some 400 and out of one wave out of 437 will be 4 times the mean wave height. Are those anomalies? No, they're not anomalies, because statistically they're within 3 standard deviations of the norm. And that's not out on the tail. You got to be out at 5 standard deviations or so to be at the tail, right? And even then, in a normal bell curve, it may be very thin, but on a real bell curve, you have what they call fat tails. So things that are not likely to happen still happen, and they happen enough that the tail is wider than you think it is. And so when you're looking at price action, and you're looking at candles and candle patterns and how candles foretell whether the price action is going to continue up or continue down, you have to look, in order to make your trading decisions, you have to look relativistically at the background of that candle, and don't get so wrapped up in the candle itself, because it's fractal, and though it will tell you something, it's fractal in relationship to the big dog up here. It's unlimited to the amount of money that we'll be able to make if you can understand how to look at candles for the value that they present to you. Not an engulfing candle, no, as an indication of economic order flow. That's what a candle is all about. Peter Rose, Longwood Currency Trading. Have a great day, and have a great trading day. I'm staggering with my voice because I haven't had enough coffee yet today. Have a good day.